All right, folks. Trust you're doing good, guys. I'm optimist. So we'll be starting the public university of trading with understanding liquidity concepts. So this will be my first video after the whole restructuring. So I deleted all old videos and then I want to make them new because of the increase in knowledge, the gap of the new wisdoms I have and the new experiences. You all know the old videos I have been 5 years ago, and then I've learned more, I've been better. And as every other case, you always know I always start my videos with liquidity. There's no course or mentorship I host. The first thing I do is liquidity because liquidity is one of the most important elements that can allow you to understand the markets. Liquidity allows you a gap of your own mind and the mind of every other traders if you know how to look for it. And that is why I always start every of my videos with understanding liquidity concepts. So yes, we are starting with understanding liquidity concepts. So for this course outline, this is exactly what we'll be learning. We'll be learning exactly what liquidity is, how liquidity has been formed, liquidity formation. Where does liquidity exist? Types of liquidity, liquidity pairing, liquidity pools, and highlights. When does a liquidity pool becomes a draw on liquidity? What happens after liquidity is taken? And trade examples. Now, maybe one way or the other, you just came across my video. I'm optimist and I trade institutional order flow. Yes, I'm a preacher of institutional order flow. I trade auction market theory. And I want you to let you know that it is best if you just take 10 minutes or 20 minutes of your time to get a journal and then start writing, because this is a whole learning curve. Yes, not only are we going to end in liquidity, we'll go over every other aspect in institutional order flow. So I want you to be intentional with it. It's free. All I just want is your commitment. Yes, and I want you to like and share this video so that we can go and reach out to more people. So we start with liquidity. What exactly is liquidity? So to keep it simple and logical, liquidity simply means orders that exist in the market. The market is a sum total of zero markets. Yeah, sum total zero market, meaning for every buyer, there must be an equal seller. For every profit you make, somebody is losing money. Every $50 you lose, somebody has made that $50 somewhere. For your buy to be executed, there must be someone willing to there's someone that is ready to, you are selling to. That's just it. When you press buy, you are selling to someone. So someone must be ready to buy it from you. So when you close a profit, you are trying to sell it to someone. Someone must buy it from you. And when you press your buy, you are buying from someone. So someone is selling from you. So that's how the market works. It's a sum total of zero markets. Meaning for every buy order, there must be an equal and opposite sell order for a successful transaction, and vice versa. For every win you make, there must be a loss for someone. Thus, liquidity is created as a result of market participation of both buyers and sellers. It's just your orders, your interaction with the market, your buy, your sell, your buy, your sell. All these things are creating liquidity. They are creating order. Anything beyond this understanding becomes complex and not needed. You don't need to know all those jargons. All you just need to know is how to spot it and how to think like someone that trades liquidity. That is all you need to know. That is exactly all you need to know. So the goal is to be aware of its existence. The intention of this video is to make you aware of its existence. So you won't need to go buy level 2 data to start looking for liquidity. By your understanding, you just know there's liquidity there. You start to think. Thought process is the beginning process for every institutional order flow trader. If you want to trade institutional order flow, you've got to think. Thought process. All right, so liquidity formation. Liquidity is formed as a result of perception of all market participants. This can only be explained using the illustration below. Now, what I mean by perception is everybody in the market is here for opportunity. Nobody comes to the market because they just feel like. People came here to make profits. People came here to hedge. Yes, people came to hedge. People came for a lot of reasons, but at the end of the day, it's always based on opportunity. So perception of all market participants is what creates liquidity. So let's assume this is a point of interest. It could be an order block, it could be a fair value gap, it could be an old high, it could be an old low, it could be anything. But every trader wants to trade from their own point of interest. That's why I said perception. What I know is different from what you know. How I trade is different from how you trade. Some people trade using indicator. All these are points of interest. So let's say we have a point of interest. The interest itself, we don't know. Maybe it's a support or resistance, we don't know. Trader A sees an opportunity to buy at the point of interest here and therefore places an entry. And therefore places an entry buy stop order. Yes, buy stop order for an entry. He places a buy stops, believing that once the market gets here, price will keep going up so as to get into the market. That is what trader A sees. However, trader B instead now sees something different. Same point of interest. Trader P sees an opportunity to sell at the same point of interest and therefore places a sell limit to get into the market. What has happened? Trader A is placing a buy stop. Trader B is placing a sell limit. Both of them we have stop losses. Both of them we have take profit. They have placed orders just based on perception of one zone, a point of interest. Is trader A right or trader B wrong? No. Both of them are seeing the market differently. Their perception is what creates liquidity. That's how liquidity is being formed. Trader A puts it a buy stop as entry here. His take profit can be high up there, but his stop loss in form of what? His stop loss will be down here. That's just it. Trader B places a sell limit. His stop loss will be above, obviously. His take profit will be below. They have placed orders. Every of your order will exist in three places, three ways. Your entry, your exits. Your entry and your exit. Your exit can be in stops. Your exit can also be in profit, in loss or in profit. But that's just it. Three. If you enter a trade, you've got to close. It's either you close in loss or you close in profit. It's either you close at the best price or you close at the worst price. That's just it. Now, this is now the logic. Same pair, same zone, but different perception and action. Same pair, same zone, but different perception and action. This is what creates liquidity in the markets. There is one of my favorite scenes in this series called, I don't know if you guys have seen it. It's called Game of Thrones. This guy was telling this short guy that power exists where men believe it to be. Your belief in the market is what creates liquidity. Your perception, your action, your will is what creates liquidity. That's just it. You don't need to know more than that. Now, your goal is now to understand what are the points of interest of every traders. If you know about strategies a lot, you understand that point of interest is support and resistance. So at every support and every resistance zone, you know that liquidity exists. Why? Because of the actions of men prior, during, or in the future. That's just it. The actions of participants is what creates liquidity. That is how best I want you to understand it. There are more definition, there are more illustration that can give you the concept of liquidity, but the best of the best is if you can understand how basic and how simple it is. You don't need to complicate it. I promise you that. So now, we are now starting to focus on the point of interest. Where does liquidity exist? Liquidity exists at the point of interest. The concept of liquidity is about perception of opportunities among market participants. So therefore, liquidity will exist most where traders seek opportunities. And the best examples of these is support and resistance zone, trend line region, old highs and old lows, daily highs and daily lows, order blocks, just to name a few, fair value gaps, indicators, a lot of things. So where you know that the market, where you know that participants are going to get more opportunity, that is where you seek for liquidity. And the liquidity of different pairs are different. So for example, there will be more liquidity on gold, Euro USD, GBP USD than on pairs like CHFs and all. Why? Because there are more participants, there are more traders trading the likes of gold and Euro USD. That's why they will tell you that Euro USD is one of the most volatile pair you can trade. Gold is also very volatile because of the people trading it. So if there is a pair or there is an asset that people don't really trade, there won't be liquidity. There won't be much liquidity. That is why my advice for traders, if you want to trade institutional order flow, is to trade volatile pairs. Euro USD, GBP USD, gold, BTC. Yes, pairs that people trade most. That is where you want the volatility, the liquidity. Yes, that's why some pairs can reach for 2 weeks. If you trade pairs like, I don't know which pair I can name. I really don't really trade much. CAD CHF. CAD CHF can range in a position for like 2 weeks because there is no liquidity. That's it. So we have two types of liquidity. We have the buy side liquidity and we have the sell side liquidity. Now we are getting to the most interesting part. You see all these zones I listed here? They are the zones you pay attention to. I pay attention to trend lines region. I pay attention to old highs and old lows, especially daily highs and daily lows. That's why I listed it. Especially daily highs and daily lows. Other blocks. If another block should fail, let me give you an example. Let's say this is another block right here. A lot of people feel this is another block. Let's say after price move down. There will be liquidity. It can be at this other block. Why? Because of the participant there. And there will be liquidity here. Everybody trying to sell from here will put their entry here and their stops most likely here. There is an order here. There is an order here. So most likely, price can take it out and now move in that direction. Yes. So that is just it. Liquidity is about understanding where do you think participants are more. You don't need access to level 2 data. You don't need fundamental analysis. You don't need much to just see. All you have to do is just to see and draw out. So we are getting to the most important part, which is what I call liquidity pairing. The understanding of liquidity pairing is what a lot of people have used in creating a lot of courses. The understanding of liquidity pairing is what a lot of people have used in creating a lot of courses. This course, CRT, is created based on the principle of liquidity pairing. I first taught liquidity pairing back then in 2022. When I taught liquidity pairing, I taught another thing called confractors. Confractors is the same thing as CRT. So before CRT came into the whole media stream, mainstream, I already thought about it. I taught it in a simple way that if you want to understand liquidity pairing, let's say this is a daily candle, and the daily candle, we have its high here, we have its low. If price should take out the daily high, if we see certain things on lower time frame, there is high probability price can seek for the daily low. That is confractors. That was what I call liquidity confractors concepts. Now, I taught it, but maybe I wasn't a good teacher then. I said I taught it. I'm talking about 2022. I wasn't really a good teacher. I hosted classes, but I realized a lot of people were confused. So I kept using it for myself. Yes, I kept using it for myself. And then later on, I got to hear about CRT. I never learned CRT. But when I look at the videos, I just understand it works on the principle of liquidity pairing. And the principle of liquidity pairing is the beginning of institutional order flow. Yes, that is the principle of institutional order flow. So what does liquidity pairing mean? Now, in the previous slide, I told you that we have two types of liquidity. We have one we call the BSL, and then we have one we call the SSL. That's the two types of liquidity we have. How is this BSL? How is it created? So let's say we have an order here, and you are selling. Where would you put your stop loss? You will put your stop loss above this high. Your SL will be above this high. Your SL is actually a pending order. It's a pending order, a stop order. A pending order, but it's a stop order. That's just it. What type of stop order is it going to be? It's going to be a buy stops. Yes, it's going to be a buy stops. Why is it a buy stops? You know you are selling. So you give command to your broker that if price comes all the way high up here, stop me out. So price is buying, you want it to stop you out. So you are placing your stop losses in form of a buy stops, even though you are selling. Yeah. Someone will also see that same region where you put your stop loss as a potential point whereby he can enter the market. So if the market is down here, he will place a what? A buy stops here. This buy stop is an entry buy stop, not an exit one. It's not a stop order this time around. It's a stop order, but it's not an exit stop order. It's an entry stop order. Oh, if price break through, I want to enter into the buy. So he places a buy limit, a buy stops here, and then his stop loss can be down here. Do you understand? The accumulation of the stop order in form of exits and entry is what creates the what we call buy side. Buy side. The accumulation of the entry and the exit is what we create a buy side liquidity. So therefore, buy side liquidity exists above highs. It exists around which one is support, which one is resistance. This one is support, this one is resistance. Yes, so buy side liquidity is the one that exists around resistant level. Buy side liquidity is the one that exists around, if you have a trend line like this, buy side is the one that exists above these highs. So sell side is the opposite. This one exists below lows. You must understand this principle if you're going to understand liquidity pairing. So liquidity pairing says that buy side liquidity, we always move to sell side liquidity, and sell side liquidity, we always move to buy side liquidity. Liquidity pairing allows you to see the market as just one big cycle in which liquidity are being paired always. Buy side to sell side to buy side to sell side to buy side. That's it. There's a trade I got on Go today. I'm going to share it at the end of this, wherever, and then I'm going to show you how it worked based on liquidity pairing. So let me give you some trade examples. I want to check if we've completed the course outline. Yes, liquidity pairing. So we are going to talk about liquidity pools and these and these and these all together using trade examples. Yeah. So the first chart example I have here is I trade gold. Yeah, is this. So I've done you a lot of justice by using these section breaks to delineate the whole daily price action. So this is a whole day, this is a whole day, and there's a whole day. Do you understand? So that's a whole day. So now what do you notice here? Price came all the way here and then came back all the way here. So if you are trading liquidity and you understand the context of liquidity, where are your zones that you believe liquidity should exist back here? Number one is this first one. That is the highest high in that day. So this becomes a PDI, previous daily high. If you're going to trade the concept of institutional order flow, you must highlight it. This is the previous daily high. We can take it out and keep going up. We can take it out and we can reverse. However, this is also the previous daily low. Can you see that? That's a previous daily low. This, like, you can see how it rejects. Some people are taking money from here. They are making money from there. That's their own strategy. That's how they see the market. So now, I want you to do justice and show me the two types of liquidity that exist here. It's very simple. Buy side liquidity. Where's your sell side liquidity? Down here. What about this? We have buy side liquidity, I up here. So here we have PDI. All this PDI will be what? BSL. PDI. All this PDI will be BSL. Buy side liquidity. All the one that exists below lows will be SSL. If you look at this appears to be like a trend line phantom. So we have SSL here, we have SSL here. That is how you must see the market. We had liquidity here prior, but as you can see, we took it out. Yeah, we took it out. Some people are selling from here. That is how you must think. Some people are selling from here. Where would they put their stop? High up here. What happened here? Price kicked them out. Yes, some people are definitely buying that. They see that as a break. And what happened? Price has now taken them out again. Pull them into the wrong side of the market. When you start to conclude your market analysis based on this understanding, price will always show you what is going on. Now, let me show you the liquidity pairing that happened on this chart the following day. So I helped you to actually draw it out. Previous daily high, previous daily high, previous daily low. This is actually a previous daily low, but as you can see, it was taken out here. Some people will buy that. Some people will say, oh, that's a breakout, let us sell. Those that sell are making money. Those that buy are losing money. That's just how it works. So now I want you to study. Can you see how we took out the previous daily high here? And we took it out here. What happened next? Price delivered all the liquidity it took all the way from here to here and then delivered it until we took out this low. That is liquidity pairing action. That is CRT. That's liquidity pairing. That's confractors. It's just names. Understand the basis behind it, and then even CRT will be very easy to you. So I said, study how price took out the previous daily high and delivered BSL to the sell side liquidity and cleared out the previous daily low. This is the principle. My F is missing there. This is the principle of CRT, candle range theory, CRT. That's the principle, liquidity pairing. I hope you guys get what I'm trying to say. I think I have another example. This is another example. So look at it. This is previous daily high. Can you see how we took it out here? And then we started to break down. Now, there are a lot of things you can look for that will give you confirmation. For example, this is previous daily high. As you can see, if you just sell directly, can you see you'll be stopped out? So there are a lot of things you have to look for that will help you in identification if price is going to reverse or not. But can you see we enter into a new day with that same cycle, but there is a cycle already in progress. That cycle is saying, oh, you know what? We want to pair this high to a low. It can be this low, it can be this low, and it can be the overall low. That is why even if you find yourself selling, you have to take profit at lows. That's it. You are doing it based on the concept of liquidity pairing. After all those liquidity was taken, what else? Can you see how price continue to move in the opposite direction? What is it seeking for? Buy side liquidity. So price is always in a cycle. From sell side to buy side, from buy side to sell side. This is the basis of liquidity pairing. And this is just 10% of the whole public university of trading. So we are just starting everything we are doing. And then I promise you, in 2 months' time, even without being able to afford mentorship or anything, you will be very, very good. So that's all. This is another example I gave out. We took out, this is the one that happened last week. This price action happened last week on gold. We took out previous weekly low. Yeah, this is actually a previous weekly low. I think I made a mistake. Yeah, this is the one that should come first. Okay, let me work with it. This is previous weekly low that we took out. Previous weekly low. You can check it yourself. This is 30th of June. We took out previous weekly low. We moved to the upside. Can you see how we came back down to a level, significant level? But right here, this is now Asian low. So yes, your Asian low, your London high, they all count. Anywhere people are trading, that is where liquidity exists. Liquidity is a concept that was created by men, the activities of participants. Without you and I, we won't be able to create liquidity. Without the institutions too, they won't be able to create liquidity. So the institutions, they know where you are trading the most. They know if you are buying, oh, this guy is buying. Where will he put his stop loss? His stop loss will be at Asian low. They know. They assume and then they just do what they do. That's just it. Knowledge is what differentiates them. That is why Michael G. Odison called them the smart money. The smart money. And he called us the dumb money. So we are not trying to think like them. No. We are only allowing them to show us. Once we see some certain things, some certain movement, we allow them to show us where price might be reaching out next. And once we can see, we align ourselves with that process and then we execute in that direction. Do you guys understand? That is how it works. And then to the final piece, can you see when we took out Asian low, can you see we delivered it to this what? Previous daily high. After we delivered it to the previous daily, can you see how we still sold before NFP cleared everything out? So that's liquidity pairing. And that is how it works. So I want to show you one of the trade I got today. I want to show you a trade I got today. This is gold. Mind you, this is gold. I got this gold sell today. And then I want to show you basically everything there. It's based on liquidity pairing. So how did it happen? Look at it. We took out this high on Monday when we woke up. So that is previous daily high being taken out. We move all the way down. We created this high. This high was created in Asian session. Then we came all the way down. Now, this is previous daily low, mind you. So we could have said, oh, you know what? We are bullish. Let us try to buy. But guess what happened next? Price just went up and then took out this high again. Which high is this? This is an high that was created on Monday in Asian session. We took it out and then we reversed. Coupled with one of the few things I'll be teaching you, I got in on the sell. And that's it. It's as simple as that. When you add all these things together, they become the breadth and everything you trade, it just starts to make sense. So guys, I hope you learn from this. Till next time, I wish you good luck and good trading. Stay safe.